Ladies and gentlemen, it is an honor and a pleasure for me to welcome all of you to this evening's public conference, co-organized by the Toulouse School of Economics and the Central Bank of Luxembourg. So, ladies and gentlemen, it is an honor and a pleasure for me to welcome all of you to this evening's public conference, co-organized by the Toulouse School of Economics and the Central Bank of Luxembourg. First, I would like to particularly thank Jean Tirole and Emmanuel Fari, a professor of economics at Harvard University, as well as the BCL staff, for having put up and organized this high-level event. The theme of the conference is topical, the future of the international monetary system. I will limit my intervention to some brief remarks on the program, which is rather ambitious, leaving no room for a long introductory speech. It is my pleasure to welcome speakers of outstanding record whose voices are authoritative in their respective research and policy fields. Indeed, we could not have wished for more informed experts to discuss this evening's topics. We will start with a lecture by Gita Gopinath, Economic Counselor and Director of the Research Department of the International Monetary Fund, and currently on leave from Harvard University's Economic Department. Her lecture will be followed by a first panel, precisely on the theme on the future of the international monetary system. This panel will be chaired by Philippe Lane, member of the Executive Board of the European Central Bank and chief economist. Will also participate in this panel Claudio Borio, head of the Monetary and Economic Department at the Bank for International Settlements, Gita Gopinath, I just presented, and Hélène, Professor of Economics at the London Business School. After a question and answer session, we will follow up with the second panel on cyber assets, central bank digital money, and Libra, and you name it. This panel will be shared by Jean Tirole, inter alia Professor of Economics at the Toulouse School of Economics, and do I have to recall, laureate of the Nobel Prize in Economics, and I think who has become a friend of Luxembourg and the Central Bank of Luxembourg. Other participants in this panel will be Benoît Coeuré, member of the Executive Board of the ECB, and more particularly in charge of market operations, and the international and European relations of the ECB, and also particularly interesting for this evening, he chairs the G7 working group on global stablecoins. And last but not least, Maurice Obstfeld, Professor of Economics at the University of California, Berkeley, and inter alia, formerly also Economic Counselor of the IMF. This panel, as the previous one, will be followed by questions and answers. And given that the academic and policy achievements of tonight's speakers are so impressive, so that a comprehensive presentation would have absorbed a session of its own, a leaflet has been distributed to you with their detailed bios. We will wrap up the conference with a reception in the lobby, which hopefully will give you the occasion for lively discussions on the outcomes of today's conference. So, without further ado, and wishing you a stimulative and enjoyable conference, I give the floor to Professor Gopinath. Thank you very much.
Good evening. It's a real pleasure to see all of you here to listen to our discussion of the future of the international monetary system. I'd like to thank Governor Reinesch for inviting me to this, Jean Tirole and Emmanuel Fari, who were quite critical in putting this panel together and bringing us all here. And so I also look forward to hearing the remarks of the other eminent speakers today. And on a topic that I think is getting a lot of attention recently, and the contours of which I believe are fast changing in recent times. Okay, so I'm going to use my slides. All right. So I'm going to talk about the future of the international monetary system. It always helps to start by thinking about what's happening currently with the international monetary system. So what exactly does the international monetary system look like right now? And the first slide, which should move, yes. The first slide that you see gives you a snapshot of the current IMS. So what you can see here, if you look at the graph on the left, is a fact that I believe is quite well known at this point, which is the international monetary system is one that is dominated by the dollar in most arenas. So if you want to look at, my mic is going up, okay. So if you want to look at foreign, that the dollar makes up about 60% of international foreign reserves. The second currency that you have is the euro at about 20%, and then it goes away very quickly. Similarly, if you look at international debt and international loans, again, the dollar dominance shows up there being, 2 to 3 times bigger than the second global currency, which is the euro. And if you think of trade and trade invoicing, similarly, the dollar has an outsized role in international trade. There are many countries in the world that use the dollar to trade with other countries, even when they're not trading with the US. When you look at global payment systems, also the dollar dominates. So this is the way the international monetary system looks. And if you think of any currencies that are trying to make any headway in there, you can see that the euro comes second, but a distant second. And if you think of the tiny red bars that you see, which is the renminbi, the Chinese renminbi, that is negligible at this point. What the right graph shows you, which is a figure from work by Ilzetsky, Reinhardt, and Rogoff, is that while it might appear that post-Bretton Woods countries have moved away from a system of fixed exchange rates, flexible exchange rates, effectively, we might have moved to a system of more limited flexibility, where countries choose to anchor themselves to a particular currency. And as the figure shows quite glaringly, that the US dollar remains a major anchor currency. In fact, in terms of the number of countries that anchor to it, you could actually make an argument that its role is even bigger now than it was during Bretton Woods. Okay, so that's a snapshot. And then I want to jump into how these things are changing over time, to a status update. There has been a lot of discussion over the past year about whether we are seeing any major changes in the international role of the dollar versus other currencies in the world. And what you see over there, and the point that I'm going to make, is that as of now, there hasn't been that much of a change. Okay? So the leftmost figure is the international role of the euro, a report put out by the European Commission. And in fact, if anything, post the global financial crisis, the international role of the euro came down. Very more recently, we've seen in 2018, we saw some uptick in the use of the euro as a global currency. But again, this is preliminary, and we'll have to see how things look going forward. If you look at the middle graph, that's the renminbi. The blue bars are the use of the renminbi for settlement purposes. And you can see that there was a substantial buildup from 2012 to 2015. You have an increase in the renminbi as a settlement currency, mostly in its own trade. This is basically China's trade with respect to the rest of the world. But that share has come down. And that change, basically, the turning point is 2015, when we saw the renminbi have a significant change in its exchange rate policy, when it became much more flexible as an exchange rate. And so while in the previous years there was the expectation that the renminbi would appreciate, there was a concern after that the renminbi would depreciate, in which case, again, so you can see some cutting back in its role as a settlement currency. But if you look at the other two pieces, which is the renminbi's role in reserves or the renminbi's role in bonds, that's the red line and the yellow line, and the relevant axis is the right axis. Those are just really negligible at this point. You also see the renminbi having a more role in oil futures market, but again, this reflects the fact that China is the biggest importer of oil in the world, and most of these oil futures are basically being traded between Chinese. It's not exactly a global market. So again, so very quickly, the future of the IMS, at least in the near term, looks very much like what it did for the last 50 years, which is one of dominance, global dollar dominance. So what does that mean for the international monetary system? Then, of course, the question is that bad, or what are the costs to it? Now, on one hand, of course, you can make an argument that when you have the same currency being used in many parts of the world, there are strong network effects that can lower transaction costs, and that's a sense in which it could be beneficial for the global economy. But we also know that that there are costs associated with it. When you live in a world which is heavily dollarized on the international market, then countries who buy goods in terms of dollar terms can face strong inflationary pressures on their economies. That can result in a fear of floating and lead to a large buildup in foreign exchange reserves in these countries, putting a huge amount of demand for safe assets, leading to a world with very low safe asset yields. There is also the concern of US monetary policy spilling over to other countries in the world, much more severely than the other way around. And we also have the global financial cycle, the origins of which can be put to monetary policy, risk sentiment in the US, and the special role of the dollar. So one could make an argument that maybe there is a need to move to a more multipolar world. Now, we don't even have to go to the extreme where everything is perfectly shared across currencies, but we could think of a world where there's some more balance in the use of these currencies in the global economy. Okay, so so here's then the question that comes up is, okay, so then how exactly do you go about? How does a dominant currency emerge? Okay, what actually gives rise to a dominant currency in international markets? So there's a quote over there which is from Barry Eichengreen, who has studied the historical evolution of or the transition of global currencies from the pound to the dollar, for instance. And he characterizes it as follows, which is: experience suggests the logical sequencing of steps in internationalizing a currency is first encouraging its use in invoicing and settling trade for kind of goods transaction purposes. Second, encouraging its use in private financial transactions. And third, encouraging its use by central banks and governments. So there seems to be that the way the sequencing works is you get your currency to be used intensively in international trade, both for invoicing purposes and for settlement purposes. And then after that, that triggers its use in private financial markets. And then that triggers the demand for countries holding reserves in your currency. So the flow chart that I have over there is related to this paper that I have with Jeremy Stein on this topic, which kind of fleshes out how exactly does it work. So quite simply, if you want to make your currency a global currency, you have to start out by creating a demand for your currency outside your own country, right? Which is, you become a global currency when it's not when the euro is being used to trade between the euro area and Canada, But it becomes a truly global currency when Canada starts trading with, say, China in the euro. That's the role the dollar plays at this point. So if you start having your currency show up, be a main big global player in international trade, and in invoicing and in settlement, then that's going to generate a lot of demand for safe assets in that currency. So let me think of the dollar. The dollar gets heavily used in international trade. That gives rise to a demand for dollar-safe assets. Why? Because you have payments that are coming due in dollar terms, and you would like to hold some of your savings in dollar form. So there's big demand for dollar-safe assets. Then the question is, who supplies these dollar-safe assets? You have, of course, the US Treasuries. You have US firms that have revenues that are pay out in dollars, and they can produce some of these dollar-safe assets. But if the demand gets big enough, you start drawing in other financial institutions to become suppliers of these dollar-safe assets. Now, these might be institutions, for instance, in an emerging market that start supplying these dollar-safe assets, but they're not very natural suppliers of these dollar-safe assets because they're backing those with domestic currency earnings. And so because of this mismatch that they have to take on, the only reason they become a supplier of dollar-safe assets is if they can actually borrow at a cheaper rate. So this is the exorbitant privilege associated with being a global currency. So if you have a decline then in the cost of borrowing in dollar, that's then going to encourage exporting firms to want to invoice their exports in dollars because you can use that then as collateral to borrow in dollars because it's a cheap funding currency. And so that closes the loop. So you can see how a lot of invoicing in trade can lead to a lot of borrowing and lending in dollar terms, which then again leads to more invoicing in international trade, and you get this reinforcing mechanism. In such a world where an emerging markets, for instance, banking sector or a small open economies banking sector is heavily exposed to dollars, it would make natural sense then for the central bank to hold dollar reserves as opposed to holding euro reserves, because in the event that there is a financial crisis or a bailout is required, the dollar would come into play. Just very quickly, you might not be able to see the pictures and the names over there very clearly, but what that figure is basically trying to tell you that indeed, if you look at the data, there is this strong complementarity between a currency used in international trade, its use as a funding currency, and and the amount of the role it plays in central bank reserves. So in the leftmost figure, what you have there is on the right, you have which are the countries that do not whose share of bank liabilities are lowest in dollars are the ones who do the least amount of dollar invoicing in their international trade, and that happens to be the Switzerland, Sweden, Norway, and Denmark. So those are the countries that are on the left hand. But on the right-hand side, if you look at the countries that do a heavy amount of dollar invoicing in their trade, this includes Korea, Japan, Canada, Australia. Those are the countries that also have their liabilities mostly denominated in dollars. And similarly you see the exact same feature for reserves. So there is this complementarity feature in terms of what countries do. Okay, so given that setup, I think a question that everybody wants to ask is, what is the reserve potential of the euro? So we see in the picture, the euro is a second global currency, but a far second. And the question is, how could one go about maybe making the euro a more global currency, or to share some more of the space with the dollar? So here again, like I said before, you need to think of how you're going to create a demand for euros which come from outside the euro area. And most of the time, it's EM countries are the ones who are using a third currency in their trade with the world. They're using the dollar in their trade with other countries in the world. And so the question is, how do you get emerging markets to use euros more in their trade? One is, of course, if you have a lot of trade if the euro area has a lot of trade with emerging markets. So what you see here is if you look at how much of euro area's trade goes to emerging markets, the most recent number is about 50%. For the US, that number is 65%. If you look at the right chart, the euro area is indeed well integrated into global supply chains. If you look at the dashed blue line over the right on the top, that includes trade within the euro area. And if you take that into account, then the share is very large. But if you look at extra euro area trade, there's not that much difference between the US and the euro area in global supply chains. So given that the US already has a head start in its currency in international markets, you can see how that can remain unless there is a dramatic shift in the trading landscape in terms of shares being done by the euro area with respect to emerging markets. Now, it's not enough to have a lot of share, but it's also important to see how much of your trade is invoiced in euros. So that's the next figure. And what we know is that it's about if you look at the EU's trade, the euro area's trade with non-euro area countries, right? So not excluding trade within the euro area. If you look at the trade with non-euro area countries, 60% of the euro area's exports are invoiced in euros and the rest is in another currency, with a large share being the dollar. So that's 60% in euros. If you think of the equivalent for the US in terms of US exports to the rest of the world, that's 97% of US exports are invoiced in dollars. So there's obviously some space to close that gap. What this figure is basically showing you, the left figure is basically saying is that if you look at emerging markets and their imports, about 50% of their imports are invoiced in dollars, and about 20% of their imports are invoiced in euros. So it's a smaller fraction of their consumption bundle that's being affected by euro currency movements. And similarly, if you look at the reserve holdings, the same, about 20% for euros. Okay, so then, so what can be done on the trade side? So I would say that there could be a bigger role for the euro being used as an invoicing currency. There's certainly, if you look at commodity pricing, commodity prices, oil, raw materials, those overwhelmingly remain in dollar terms. Of course, expanding the scope of trade itself would help, and the EU certainly making great strides in that. And, EU trade with Japan, with Mercosur. So these are all avenues through which one could raise it. Then a question that has come up is, would issuing euro bonds help? Right? I mean, I think this comes up often, which is that if you want to make it a more bigger reserve currency, would issuing bonds, euro bonds, help, which is having a euro-wide common bond? The question, of course, to ask in that case is that how would that increase the demand for euros, or for euro bonds, correct? Because just increasing the supply of euro bonds will certainly, you end up in a world where more people are holding euro bonds. But if there's no change in the demand for euro bonds, that's going to just raise the interest rates on those bonds and going to make it less attractive as a funding currency. And if you remember how I explained how the loop works, it really comes through increasing demand for euro-safe assets that would then lead to making the euro a more attractive funding currency. So just if all you're doing is increasing the supply of euro bonds, you certainly it serves many other purposes. But how does that trigger an increase is hard to see. So again, what you see on the left chart is that it's certainly the case that we live in a world where almost all of the safe asset creation is being done by the US, close to 30 trillion. If you look at what's happening in the euro area or other advanced economies, and both are on the right scale, you can see that for the euro area as a whole, it's about 11 trillion. But if you think of the some of the safe asset portion of it, so for instance German bonds, we're talking it close to 2 trillion. So there's clearly a big difference in scale. But it still has to be the case that if you want to, again, trigger a virtuous circle where the euro becomes a much more global currency, it's not enough to increase the supply of it without generating a demand for it. Now, of course, you could do that. You could do that, which is that if you have more euro bonds out there in the market, which means makes the market more liquid, less price risk, then you can see an argument where that will then start generating a demand for euro safe assets, and that could trigger the mechanism. Now, it's easier said than done because of what the right chart shows you. This is from work by Majuri, Nyman, and Schrager, what they say is that if you look at corporate bond issuance, the US is quite the exception in that US corporates can issue bonds internationally that are denominated in their own currency, which is in dollars. But pretty much every other country in the world, once they go to international markets, they really have to cater to the investors' demand for the currency in which what's the preference from the investor's perspective of the currency to denominate the bond in. So again, the focus has to be on creating an increase in demand for euro-safe assets. Okay, so what's the next piece? And I think this is probably the most important factor in internationalizing the euro even more, is to strengthen the credibility of the euro. Now, on the left chart, I have this figure, which is from Centix, which is basically a survey that asks individuals and institutional investors, what's the probability of a euro breakup? Okay? And you can see that in the peak of the crisis, the probabilities were very high. They went up to 70% in 2012, 2013. And it came down, again, it moves up, and now it's that's the lowest since the index came out, which is at around 10%. But still, to think of if a currency has to be a global currency in the international market, and this cannot be a chart that anybody ever wants to express an opinion on, which is what is the probability that your currency might not exist, right? So the takeaway from that is that I think this is probably the most important thing that needs to be done, is the reforms have to continue to complete the euro area architecture because that will then boost credibility. And the reforms for that have to be both union-wide and at the national level. So union-wide, this has been talked about much before, with banking union, there's need to be a capital market union, a central fiscal capacity. It must seem that this is not a question that is on people's mind, which is what is the possibility of the euro breaking up? Because these countries have to be made more resilient in terms of their national markets through reforms on labor markets, product markets, fiscal side, corporate solvency. So these reforms have to continue so that there's not ever an expectation that next time there is a big recession or a global crisis that the euro's existence is at risk. Okay. The next question that, of course, people can bring up, which is the future of the international monetary system, is the role of these new kinds, the new fintech payment mechanisms. So there are many kinds. I know we call them by the name of stablecoins. I'm not going to talk a whole lot about it because there's a whole panel that is dedicated to this particular topic. But just very quickly, why is this such a big issue? Why are we paying so much attention now to these kinds of stable coins, private money that are being issued by big tech firms? And the reason I believe is that unlike crypto assets like Bitcoin, where the demand for that came from people who wanted to speculate in their investment, right? So that's where the demand came from. You can think of these tech firm issued stable coins as drawing demand which comes for demand for transactions and demand for trade, which is why they have a bigger role for being disruptive to the international monetary system, because they generate a very large demand from a large segment of the population. They have a large user base, and it is about the really inner, kind of fundamental workings of a currency, which is its use for trade in goods, for payments, and for transactions, not about financial speculation. Now, if you want to think about what the benefits and costs are, of course, there's a trade-off, which is, it's certainly the case that, the current payment system that we have doesn't work great for cross-border payments. And you can see why the new technology can help lower those transaction costs. It can potentially generate greater financial inclusion, improve user experience. But of course, there are stability risks. There are risks associated with liquidity mismatch. There's risk associated with deposit substitution. This is exactly what we think about from how Barry Eichengreen talked about how the whole beginnings of this starts with the use of the currency for trade and goods transaction purposes, and then becomes a demand for deposits, and then becomes a source of funding currency, and so on. So there are legitimate concerns of currency substitution, especially in countries whose currencies are not the reserve currencies of the world. So there are very important questions to ask. And like I said, they have the potential, more significant potential, to be disruptive to the international monetary system, unlike the other kinds of fintech payment technologies that we have seen before. Okay, I am almost out of time, so I'm just going to flag to you that given that the evolution of the IMS, at least in the near term, might look more like what it does today, with not that much of a disruption happening in the near term. What that means is that because this is the kind of system that we live in, we are living in a world where, because most of the trade is done invoiced in dollars, it means that the ability of a country to increase its exports when its currency depreciates is not that great. It also means that exchange rates become much more volatile for emerging markets. Because a lot of borrowing is being done in dollars while the revenues are in local currency, you have a mismatch problem, balance sheet mismatch problem, which means exchange rate movements can have an effect on that. And you have many countries building up large reserves of safe assets and generating historically low interest rates. So in the next couple of slides, and I'm just not going to go into those because I'm almost out of time, but this is what we are dealing with at the IMF is basically to figure out what's the optimal tool of policies, optimal mix of policies that such countries can use, which I mean optimal mix of monetary policy, exchange rate intervention, macroprudential policies, and capital flow measures in dealing with financial shocks, capital flow shocks when you live in an environment like this. Most countries in the world use all these tools, but I don't think we have a systematic way of thinking about it. And we are, at the IMF, we are working towards providing such a policy framework, which is called the Integrated Policy Framework, where we look at country shocks, countries' characteristics, and come up with an optimal mix of tools to be used, given that this is what the international monetary system looks like at this point, and possibly for a while. Thank you.
Okay, let me thank Gita for an excellent opening presentation. The format of this panel will be, in a couple of minutes, I'll hand over to Claudio and then to Hélène to make presentations. And then when we turn to Q&A, not only will you have an opportunity to respond to the panelists, but also you can follow up to Gita's presentation by asking Gita questions on her presentation. So let me make a few opening remarks from the point of view of the ECB. What's interesting, maybe in terms of the framing of what we mean by the international monetary system, maybe I'll just start with a fairly basic, simple point, which is, of course, the euro is, in effect, one way the 19 member countries have addressed the challenge of international monetary economics. So by adopting a common currency, many of the issues which I'm sure everyone's going to be talking about in terms of the mismatch issue, the need to hold a lot of FX reserves, all of these issues in a counterfactual where we still had 19 national currencies instead of the shared currency of the euro area, you can imagine that world. So the international monetary system debate, where we're more outwardly focused away from the euro area. Of course, it's always important, I think, to make that first point, which is, from a national perspective, one reason why so many countries are signed up to the euro, one dimension of that was essentially to solve some of these issues. Having a common central bank, which provides automatic liquidity, really does a lot in terms of a safe harbor for the member countries. Given that so much of trade in the euro area, as Gita noted, was within the euro area, having a common currency, just basically creates a lot of matching. And a lot of the cross-border finance in the euro area is in the euro, which is the shared currency. So historically, of course, many member countries would have had a lot of FX debt, native debt in their own currency, the shared currency. Now, I know there's many philosophical debates about, is the euro a shared currency, a foreign currency? What kind of currency is it? And maybe we can come back to those issues. But then if I turn to the wider issue of thinking about the euro and the euro area in the global monetary system, I think some of the issues Gita raised are very important. And let me emphasize, this is not just in terms of what is welfare maximizing for the world, even for the euro area, which by and large, of course, most of the transactions in the euro area are in euro. It is a different issue, but it's still super important. Globalization is so extensive. The currency denomination of trade, of invoicing, of finance really makes a big difference. And I can tell you, when we are looking at the ECB, for example, last week in any meeting we go to, the dynamics, the basic dynamics of money in the euro area, what is driving the development of M3 and so on, very much is influenced by global investors. So the portfolio choices of global investors, Asian investors, US investors matters a lot for the monetary dynamics, which are a central part of what we look at. Let me also point out that we are, Gita said, absolutely true, this is fast changing, it's a very live issue. And for example, one of the interesting elements of, again, from a euro area perspective is absolutely in terms of thinking about the exchange rate. Honestly, I think the trade-weighted exchange rate has played a central feature always, but increasingly we have to look into, well, is that trade in dollars? Is it in euro? What currency is it? Because when you have the mismatch between trade and invoicing, it really makes a big difference to understanding the impact of movements in the exchange rates. So I think having said all of that, maybe the last point I'll make before asking Claudio to present is, let me endorse something that Gita said, because we already know the answer, by the way. Here in Luxembourg, the home of the ESM and the European Investment Bank, and I'm pretty sure those in the audience from those institutions will agree with me, global investors love supranationals. They love euro-denominated debt, which is issued by European institutions like the ESM and the EIB. And I think we already have a leading indicator that the demand for euro-denominated issuance by European institutions really is extremely popular compared to any national currency because of the fact that Europe stands behind that. And I think that's so important. And again, the other point which is interesting about internationalizing the role of the euro is this is essentially the same agenda as what makes sense for the euro area, banking union, capital markets union, strengthening the credibility of the euro is important for domestic reasons, but it happens to be exactly the same list of requirements to make the euro an international currency. So with that, let me turn over to Claudio.
Well, thank you. Thank you, Phil, and thank you, the organizers, for the very kind invitation. Now, this panel is about the future of the international monetary and financial system, and also, as Gita alluded to, talking about the future is a risky business. I'm sure you all know that famous phrase, it's difficult to make predictions, especially about the future. So let me talk about the past and the present before making some very timid inferences about the future. I will address two questions. First, what's wrong with the current international monetary and financial system? And second, what can be done about it? And I will, so as to confuse things a little bit, I will make 3 points. So, first point, I think there is a long intellectual tradition arguing that the international monetary and financial system's Achilles heel is its proclivity to generate large current account imbalances. This goes back to Keynes' structural contractionary bias, reflecting asymmetric adjustment between surplus or creditors and debtors. Current account deficit countries must contract. Current account surplus countries don't need to expand. Bernanke's thesis that savings glut was at the heart of the great financial crisis Large current account surplus countries in emerging market economies pushed interest rates down and fueled the housing bubble. And I would add also the close cousin, which is the safe asset or safe asset shortage hypothesis, which again talks about excess saving. Now, this tradition is reflected in the main preoccupation of the G20, for which the word imbalances is in effect synonymous with current account imbalances. Now, of course, current accounts do matter. They matter a lot. As we see today, large current account surpluses exacerbate protectionist pressures. Current account deficits constrain emerging market economies, not least given how closely financial markets watch them. And partly for the same reason, large current account deficits can deepen exchange rate or financial crisis. But to my mind, the role of the current account is overestimated. And here, let me just mention a couple of reasons. First of all, current account imbalances do not generate a significant contractionary bias at the level of the system as a whole. In general, advanced economies are not constrained by them significantly. Think, for example, of Australia, that has had 45 years of uninterrupted large current account deficits. And the country that is at the very core of the system, and we heard quite a lot about that, the United States, it's hardly constrained at all. Recall how pre-crisis, concerns about the unsustainability of the United States current account deficit and about a dollar crisis actually proved unfounded. When the crisis occurred, and in the United States, the dollar actually appreciated. Now, to my mind, and this is the second point, the savings glut hypothesis is not particularly convincing. As a matter of identities, current accounts tell us very little about financing and intermediation patterns. By construction, the latter is about gross positions, assets and liabilities. Indeed, as we have stressed in our BIS research, the great financial crisis was very much a transatlantic, not a trans-Pacific affair, with the European banks at the very core of the crisis. Banks located in the UK, which was a current account deficit country, and in the euro area, which was in balance. And with US dollar funding playing a key role, including that provided by intermediaries in the United States, not least mutual funds, which were providing funding to these banks. Now recall, for example, the huge need for US dollar swaps in order to calm the markets. In fact, the US current account narrowed only marginally, while gross flows collapsed in 2008. We're talking about the difference between 20 billion and 1.6 trillion in terms of the gross flows. That was a 75% drop. Now, and as a matter of behavior, and I know that this is more controversial, in our empirical work, looking across countries and going back to the 1870s, we have found little relationship between real interest rates, on the one hand, and saving and investment drivers, the two variables that define the current account, on the other hand. I mean, there is a pattern that qualitatively works from the 1980s onwards, which is the focus of much of the analysis, but if you go further back, you effectively see no systematic relationship. Rather, what you do see is a link with monetary policy regimes. And again, here financial markets play a key role, and I'll come back to that. Second point, related to the first, to my mind, the real Achilles heel of the system is the failure to anchor successfully financial expansions and contractions, both across borders and within countries, and their corresponding increase in debt. Increase in debt, which can cause major macroeconomic dislocations and financial crises, what we have termed excess elasticity. Think that you have an elastic band that you can stretch out, but the further you stretch it, the more it sort of comes back. Now, this actually results in a short-term expansionary bias, but a long-term contractionary bias once financial expansions turn into contractions. So put differently, the right focus is not so much on the difference between saving and investment or net capital flows, which is what current accounts represent, but on gross capital flows and their corresponding stocks. Gross flows that simply dwarf any net flows, and Phil has actually done quite a bit of work in this area. So, if you like, the focus should be not so much on current account imbalances, but on financial imbalances. Now, such financial expansions and contractions come in two forms. First, expansions and contractions in gross capital flows and correlated asset prices. I mean, Hélène's global financial cycle that Gita mentioned earlier is the latest and most famous incarnation of this. Now, these cycles, as our research has tended to find, tend to coincide with the business cycle. So roughly their length is similar and their covariation is similar. And second, the second type of financial expansion and contraction is what we call domestic financial cycles. Now, these are best captured by strong joint expansions and contractions in domestic credit, and in particular property prices. Now, these cycles are considerably longer than business cycles, sometimes twice as long even, and they are the main source of costly recessions and possibly outright financial crisis. In fact, by the way, in some recent research that we published last year, we were comparing the famous yield curve inversion and financial cycle indicators as measures of leading indicators of recessions, and financial cycle measures turn out to perform better across a large group of countries. So while conceptually and empirically these two notions of the cycle are distinct, the two types actually interact and can amplify each other, especially around financial crises. Now, the international monetary and financial system fails to provide sufficiently strong anchors because of the interaction of monetary and financial regimes. On the one hand, monetary regimes pay little attention to the build-up of financial imbalances. I'm talking about domestic monetary regimes. So that the easing bias spreads from the core economies to the rest of the world, regardless of domestic conditions there. And this is part of what you call the global financial cycle. This easy bias spreads directly through the extensive reach of the international currencies, and in particular the dollar, beyond national borders, so you get an immediate direct impact on financial conditions elsewhere. But importantly, also indirectly, through policymakers' resistance to exchange rate appreciation, out of concerns with unwelcome disinflation if you are below inflation targets, or for other reasons, including financial stability and possibly even competitiveness. That is, central banks elsewhere keep interest rates lower than would otherwise be, and or intervene and accumulate foreign exchange reserves, which in turn puts downward pressure on the yields in the core economies, as you mentioned earlier. So this way, easing begets easing across the world. On the other hand, the interaction of financial regimes reinforces these channels and effects through the free mobility of capital across both currencies and borders, so that external funding typically amplifies domestic credit booms. That is, foreign credit and foreign currency credit tends to outpace domestic credit during these episodes. And exchange rates move too far, the famous overshooting phenomenon, for exactly the same reasons as domestic assets do, so that the insulation properties of exchange rates are imperfect. Hence also the relevance of the concept of global liquidity, that is the ease of global financial conditions, which is something that we focus a lot on at the BIS. Now, what's the evidence for all this? Let me just mention a couple of things given the time available. First, surges in international credit ahead of episodes of serious financial stress. We saw it ahead of the Great Financial Crisis. We saw it in the Latin American crisis of the 80s, in the Asia crisis of the 90s, and so on. And if you go further back in history, this is a typical pattern. Now, from this perspective, the post-crisis surge in dollar credit to the rest of the world, advanced and emerging market economies, is something that I think should be watched closely. And by the way, quite a bit of that increase is hidden, because it has taken place through foreign exchange swaps that are not captured. They're not captured by the Banque statistics, for example, that we produce. Now, triangulating our derivative statistics and the banking statistics, we try to come up with an estimate of how large these foreign currency swaps are in dollars. So if you take, for example, the amount of non-bank borrowing outside the United States, that's roughly a little bit less than 12 trillion. If you actually calculate how much dollar borrowing is done through FX swaps, that's similar order of magnitude, but if not larger, something about 14 trillion. So this is a huge amount of dollars that you do not see in the balance sheets, in the statistics that people normally produce. The other piece of evidence, I think, is unusually accommodative monetary policy conditions, both before and after the crisis. Interest rates have declined and remained unusually low in both nominal and real terms. And indeed, in real terms, interest rates have been negative for longer than even during the great inflation period. And moreover, they are negative even as quite a number of countries are roughly at or beyond standard estimates of potential. So, given all this, and this is my third point, what are the policy implications? Let me suggest four. The first implication, I think, is that there is a need to rebalance the focus of international macroeconomic cooperation away from current account imbalances towards financial imbalances. The second implication is that because financial imbalances can also develop in current account surplus countries, attention to current account imbalances may, under some conditions, at times, be counterproductive. The reason is that pushing a current account surplus country to expand could actually amplify domestic financial imbalances. That is what we saw in Japan during the 1980s. And in fact, there are many examples of current account surplus countries coinciding, having financial booms. Now, if you go further back in history, probably one of the most spectacular was the United States ahead of the Great Depression. But more recently, just to name a few, China, Nordic countries, Gulf countries, Korea, Thailand, Switzerland, and I could actually go on. So these are countries that have current account surpluses, but in a number of them, you actually see the buildup of financial imbalances that could cause problems. And indeed, the country that I come from, Switzerland, is a case in point. Third implication, I think we need stronger anchors in domestic policy regimes, if you like, ensuring that your own house is in order. And at the BIS, we have argued that for this, you need to put in place macro-financial stability frameworks in which monetary policy, prudential, in particular macroprudential policies, and fiscal policies pay greater attention to the buildup of financial imbalances. And in fact, in this year's annual economic report, we devote a whole chapter to monetary policy frameworks in emerging market economies, explaining some of the key aspects of this. In particular, the role of foreign exchange intervention in the spirit of a macroprudential tool, combined with the active use of macroprudential tools. Now, if you get your own house in order, this should automatically reduce unwelcome spillovers elsewhere. And the fourth implication is that we need stronger anchors internationally, that is ensuring that the global village is in order. Now, the degree of progress here has differed across policy areas. I think it's been substantial in prudential regulation and supervision. We've seen how much has been done after the crisis. I think it's been limited in the context of monetary policy for obvious structural reasons. So here, I think the question is whether it would ever be possible to go beyond what you might call enlightened self-interest, so that the countries take into account the spillbacks from their own spillovers into their policies. And of course, strengthening the global safety net would actually help in case prevention actually fails. Now, so much for the normative aspect. What about the trickiest bit, which is trying to say not so much what should be done or could be, but what is likely to happen in the future? Well, it may well be that the international monetary system that we know today, we know tomorrow is going to be very similar to the one we have today. But of course, there is always an outside chance. The question that we have to ask ourselves is how resilient the system is if we were to have, at some point in the future, another major shock. Now, one possibility would be that protectionist forces would overwhelm the defenses of the system and usher in a wave of trade and financial protectionism. Now, this happened in the past, if you look at history. I think the question that we should all pose ourselves is whether it could happen again in the future. Now, if that happened, the international monetary and financial system would be quite different. The set of problems that we would face would be entirely different. But the world, I'm sure, would not be a better place. Thank you very much.
The panel is indeed about the future of the international monetary system, and as was pointed out both by Claudio and Gita, this is a pretty risky thing to talk about. History of money in itself is very fascinating. So here you see that we've gone in a few thousand years from very specific objects and weird objects that were money, medium of exchange or store of value, to some kind of digital or crypto things that are called in some ways money. So that points out that we are in a very tricky territory when you try to think about what may happen in the future. Nevertheless, we are going to give it a shot. So I have a very similar graph to the one of Gita, showing essentially that the dollar is by far, by many dimensions, the first international currency in the international monetary system today. Something that may come as a shock to people thinking that, in a way, the end of Bretton Woods was a run on the dollar, and out of the dollar into the Deutschmark in particular. And nevertheless, after 1971, 1973, we still live in a world which is pretty much dollar-dominated. I have one more bar on this chart compared to Gita. The gray bar on this chart is sterling. And sterling used to be the main international currency until sometime in the middle of the 20th century, and it just shows how it is possible to have a massive reversal in the importance of international currency. Going from sterling to the dollar happened over quite a few years, and after, one could say, quite a few very heavy shocks, such as maybe the World Wars and the Great Depression, and then finally the Bretton Woods Conference. But it just shows that it is possible to have switches in the international monetary system from one main currency to another. Now, someone who had spent a lot of his time thinking about the different function of international currency is Peter Kennan, who was professor at Princeton University, and who kind of, in a way, explains to us, or explained to us in his work, why it is such a very inertial system, the international monetary system. Why is it so stable when the system settles in one currency as the main international currency? So why was the sterling the main international currency for so long, even though the UK economy declined in relative importance compared to the US economy quite early on, end of the 19th century, beginning of the 20th century? Already the US was a very important economy in the world economy. However, it was still sterling that was the main international currency. And the reason why there is so much inertia in the system and why the dollar has such a comfortable position in a way right now is some of these complementarities that Gita talked about very nicely in her presentations, which is that if we consider the role of a currency as, we think about them in monetary theory, medium of exchange, store of value, unit of account. You use a currency to transact, you need a currency to store your wealth, and you use your currency also to count. So if we think about these three functions, both in the private sector, in households' hands, but also in the official sector, central banks, there are lots of complementary feedback that goes into these different roles that makes one currency useful for one role, also useful for another role. And hence, once a currency is used in one role, it is very likely to be still used in another role. So if you transact in dollar, it's nice to have your wealth in dollar. It's also nice to have a stable exchange rate vis-à-vis the dollar, which means that your central bank also has a lot of dollars, which means that financial stability also goes through having dollar reserves, and vice versa, and so on. So that makes the use of an international currency, or the importance of an international currency, a very stable phenomenon. And if you are the only one deciding to deviate one day from that equilibrium, if you are the one saying, I'm not going to use dollar, but I'm going to use another currency, then you are going to pay a lot of transaction costs, because other people are going to be using the dollar. So you're going to face illiquid markets, you're going to face potentially unstable value of your currency vis-à-vis your consumption basket, and so on and so on. Therefore, it's going to be very difficult for you unilaterally to deviate from that equilibrium. That enforces, in a way, the role of a dollar as an international currency in a very strong way and in a very durable way. Now, somebody who was very interested in the international currency role of a dollar, and which is here unusually represented on a dollar bill, is Charles de Gaulle, the General de Gaulle in the 1960s, who pointed out that indeed, having the dollar as an international currency was a pretty nice thing for the United States, because what he was thinking about especially is because everybody likes to have these dollars to do all these functions that I just discussed about. Well, that also means that whenever the US government wants to issue more dollar liability to finance something, or in general, when agents in the US need financing to finance their imports or other such things, then it's very easy to find in the rest of the world demand for those dollars. Everybody is happy to actually invest in those dollar assets, to hold them. And that means that you can issue pretty much large amounts of safe assets at a high price, because there's a lot of demand for those assets. So I'm going to quote de Gaulle here. He says, this unilateral facility that the United States has means that the dollar is not an impartial means of international exchange, since it is a means of issuing credit for one state. In other words, because there are all these properties of the dollar, people wanting dollar means that the budget constraint of the US as a country is relatively soft. And this is a great advantage. Now, he was obviously very jealous of that and took some actions against that. However, one thing that maybe he was not so worried about or interested in is the fact that if you are a country at the center of the international monetary system, you're also the international lender of last resort of that system. And you also provide insurance to the rest of the world. Your assets are safe assets, and other countries' central banks, for example, hold those assets. Private sector of other countries hold those assets. And these assets have to keep their values in bad times. So you have to run pretty consistent policies, responsible policies, and have enough fiscal capacity to back the value of these assets, particularly in bad time. You are providing the insurance as the reserve currency issuer to the rest of the world. So this is, in other words, maybe we can call that the duty of the country which enjoys the privilege of issuing the international currency. And because of this specific role of the international currency issuers and the very large amount of liabilities, so dollar, for example, treasury bonds, treasury bills, or government bonds which are held in the rest of the world, the value of these treasury bonds being obviously guaranteed by the fiscal backing of the US government, we may have a problem if we look into the future. So here it's more speculative, of course. So why would we have a problem? We would have a problem because if you look at the size of the US economy in the world, which is on this graph here, so you would see the US size going down, it's the red line, and the China going up sizably. Of course, European countries also tending to shrink. But the size of the US economy shrinking in the world in a situation in which, at the same time, the demand for US safe assets is not going down. In effect, it's been going up because you have a lot of emerging markets growing fast. You have a lot of people in the world who are demanding US safe assets. And there's a problem of mismatch, in a way, between the growing demand for US safe assets and the size of the US and the size of the US economy in the world economy. So because of that, because of this problem of a shrinking hegemon, as we could call it in the world economy, we might have at some point a confidence crisis. Will people in the rest of the world believe that the liabilities of the US that they hold, these dollar assets that they hold, will keep their value if there's a lot of these liabilities in the world and the shrinking size of the US economy? That's the question. That's the question of a shrinking hegemon. So if we think the dollar hegemon is not sustainable, then that means we have a new Triffin dilemma. So the Triffin dilemma was Robert Triffin in the 1960s, explaining exactly more or less the same type of issues, except that at the time, of course, the dollar was pegged to gold. So the problem was maybe more pressing. You had a lot of people holding dollar assets in the world, a growing demand for those assets, and those assets were supposed to be redeemed at fixed parity with gold. There was a true possibility of confidence crisis here. If I believe that you are going to transform your dollar into gold, there may not be enough gold for me to transform my own dollar into gold at a later date, and so we are going to have a run. That's a confidence crisis. So if the analysis I just gave is indeed relevant for today's environment, then we may see a new Triffin dilemma. And that means that at some point in the future, the global economy will have to switch either to another single international currency, or because we see several economies being important in the world economy besides the US, there's the European economies, there's also China, we might switch to a multipolar international monetary system. And this is the next speculative question. In order to get out of the dollar, you have to get out of the dollar into something. And the question is, what is the something? So, as was pointed out already by several of the speakers here, one natural candidate is the euro. If we think about the euro, there might be some issues, and which I will discuss briefly later. One is the RMB. Others we can think about is cryptocurrencies, these digital currencies, or a basket of digital currency, as was recently proposed by Mark Carney, the governor of the Bank of England, in a speech. Now, just to go back in time for 2 seconds, very naively in 1998, I was looking at the possibility of the euro actually replacing the dollar as the main international currency. And there I was writing that the internationalization of the euro would hinge critically on a number of factors. And at the end, you see between brackets, there was especially on UK participation of the European Monetary Union. So that was a little bit of an issue here. Anyway, so besides this problem with the euro, so if we go back towards, will there be switching to the euro, I think there's a number of issues with the financial architecture of the euro area, and in particular the lack of a true euro area safe asset, which has been alluded to, so I won't dwell on that. And indeed, doing the right thing for the euro area, as Philippe pointed out, would be also doing the right thing for the internationalization of the euro. RMB, well, I would say currently we are very far from having developed enough financial markets, convertibility issues. So maybe in the future we are, but in the immediate future, it's very hard to see the RMB internationalizing very fast. Cryptocurrencies, I'm going to be quite brutal here. To start with, it's not clear why these things exist at this stage, not clear which problems they solve, and very clear which problem they create, so I wouldn't see them as any reasonable candidate here. Digital currencies are much more of an interesting topic than cryptocurrencies. So we can think that digital currencies may bring in better technologies as medium of exchange. As I tried to point it out, this is not enough to be an international currency. You also need to be a safe asset. So here, obviously, if it is a sovereign-issued digital currency, why not? But then we inherit the safety property of a sovereign, and some sovereign can definitely do that. This is also true if we do the synthetic basket of currency, the synthetic hegemonic currency proposed by Mark Carney. It's also potentially a better medium of exchange, but it would be essentially a basket of several sovereign digital currency that could solve the problem of a shrinking hegemon, but we still have the issue of the safety of that thing and who backs it fiscally, which is a similar problem to what we have had with the special drawing rights at the IMF, and probably why they never took on any international importance, at least so far. So the last thing I want to say about these digital currencies, because I think there's going to be a panel, following panel will talk a lot more about that, is that it is absolutely a good idea for efficiency to have better transaction technologies, but new transaction technology do not need at all to be coupled with new currencies. You can very much improve on transaction technologies, in particular cross-border, without having to introduce a new currency. And usually, so it's the government who is the issuer of a currency. It is the government which imposes a currency as a legal tender within its border. And in exchange for that, it provides very valuable public good in exchange. It provides monetary policy stabilization. It also provides financial stability. Now, if we think about privately issued currencies, I can see that the use of it could be enforced via a network, essentially, of customers with privileges and stuff like that. But I'm asking, what is the public good that is being provided here? I can see the profit to the big firm issuing it in exchange. So this leads me to think that indeed the regulatory environment has to be very careful about those matters, since the public good provided via monetary policy and financial stability are extremely, extremely valuable. So based on all that, I think, to conclude, if we think about the future, we'll probably still live in a dollar world for a while.
Thank you, Hélène. So in a minute, we'll turn to Q&A. So there will be people going around with microphones. If you're called upon, if you can identify yourself in asking your question. But maybe I'll just take 30 seconds before opening it to the floor, just to maybe endorse some of the points that were made. First of all, a little bit of an ad. Hélène correctly pointed out, it's very important to have efficient cross-border payments. And of course, in the euro area, 19 member countries, through the TIPS system that the ECB provides, super cheap instant payments across the euro area. The big challenge, of course, is across currency areas, across currency zones around the world. Let me mention, coming back to some of the points Claudio made, is really, and this is really also in Gita's presentation, is given all of these many dimensions, it's so essential to have this integrated policy framework, as the IMF mentions. In the euro area, it's so important now to, when we think about monetary policy, to also think about macroprudential policy, because of course side effects in terms of the financial risk-taking that Claudio mentioned, which correctly often shows up in current account surplus countries, not just in deficit countries, macroprudential is so important. Let me mention, Claudio correctly highlighted the issue about currency swaps, or more generally, FX derivatives. And this is an interesting point because for many small countries, being able to issue in dollars or in euro, and then being able to eliminate the currency risk by swapping the currency risk with a provider of those services can be quite efficient. And by the way, one reason why the creation of the euro meant so much more dollar fundraising by Europeans was the euro-dollar swap market was so big and so cheap. Small countries in Europe could borrow in dollars and get rid of the currency risk in a way that was not possible before the euro. So, I think there's many questions raised here, but of course, in the European Union now, Claudia mentioned there's a big data gap with derivatives. In the EU now, with the EMIR data set that the financial firms are reporting to the European institutions, including the ESRB, we now have more understanding of what's going on. Let me also maybe have one quibble with Claudio. I don't think it's an or question. I think it's possible to care about current account imbalances and gross imbalances rather than saying ranking them necessarily, because of course current account imbalances have well understood issues as well. Having said that, I'm sure in the time we have, there's going to be all sorts of questions for the panelists and for Gita. And it's a little bit dark, so I won't be able to necessarily identify myself. But the first hand is here, Pierre. So.
Thank you. Lazarus Panurias, European Investment Fund.
Okay.
A question a bit unfair because likely is more for politicians, but the question is, the international monetary system, the existence or lack thereof, is being blamed currently for many misfortunes. So what you would say in defense of the international monetary system, current or future one?
Okay, that's a very good first question, but I think for time management, we'll collect a few questions before turning back to the panelists. So please, over here.
Thank you very much for the panelists. So this is Gong Cheng from the European Stability Mechanism. My question is related to the international currencies for trade invoicing. So Gita has a few papers about the dollar dominance. And my question is more to ask Gita and also the panelists about whether to facilitate like local currency pricing or destination currency pricing, is it a choice, a micro level choice, or there is room for policy intervention? And if there is possible room for policy intervention, should we do it for policymakers? Should we push for it? Like China, for instance, has had initiatives actually to promote RMB settlements for trade. But it has been probably successful with a very limited scope. So is there really externality for policymakers to push for it? Thank you.
So right in the middle of the...
Sebastian Wien, European Investment Bank. Do you think that the negative interest rates will make the fiat currencies less relevant, especially in comparison with gold?
Very good. So let's take one more question. And I see someone just on this side of the audience with his hand up in the middle there.
I'd just like to ask a question regarding the cryptocurrencies and that it has such a negative image here. From a client perspective, I just would like to ask why a cryptocurrency should not be attractive from your point of view, because let's say as long as in an economy I'm certain I can exchange goods with that currency, be it crypto or not, I can use it. Interest payment might at the current state also not interest me too much. So I just would like to know what other detrimental impacts you would see.
Okay, so thank you for that first round of questions, and maybe I'll go in the asking first Gita, then Claudio, then Hélène, if they have any responses to those. So Gita.
Okay, so just very quickly to your question on a currency's use and whether policy can play a role in expanding it's the stage for a currency. I mean, the very fact that countries require that their citizens use their own issued nominal, their currency is a policy-induced use of a particular currency. So there is obviously a huge policy aspect to it. But if you want to start making your currency, much more globally attractive, then, and if I think specifically of the case of China, while it is the case that China is a huge player in international trade, it's still more fledgling when it comes to financial markets, when it comes to convertibility, exchange rate flexibility, monetary policy. So to become a global currency, all these pieces have to come together, which is not just important that you're a big player in international trade, but you need to have very strong financial systems and strong central bank policy and monetary policy making. Those things bring about the change. So the defense of the IMS, so firstly, I wouldn't say that all the problems of today are because of the international monetary system. I think there are plenty of other important issues that we have. I would put, trade frictions, trade tensions. We have emerging markets that have their own domestic policy issues. So there are many aspects to it. The bottom line is that historically, it's always been the case that there tends to be one dominant currency. Sometimes you have more than one currency that shares the stage, but those are very few decades. So it's almost always been, the international monetary system has always been one where there's at least one currency that has a huge presence. You can think of arguments why that could be positive, what I mentioned, which is network effects, lowering transaction costs, not having to go between multiple currencies in the world. But at the same time, we are also aware that there are these, there are these costs associated with it, where individual countries feel like they are being hit by financial shocks that originate in another country, that monetary policy spillovers from the center to the periphery. I don't think it's obvious at this point, how big the costs are relative to the benefits, and whether we will ever get to a stage where we have somehow equal sharing across multiple currencies. I could see an argument for there being a little more balance on international markets. But then I think we also need to build up systems of the international lender of last resort, where the IMF plays an important role. I mean, we would need to build those institutions up very quickly. Again, on cryptocurrency, I think there's a pretty wide set of, it's a very wide definition. So again, there's something like Bitcoin, which some people want to speculate in that. You can see an argument, well, why you might let that happen. Then, of course, there is other kinds of currencies which are more take the form of affecting payments on goods, making as a settlement currency, and that's where things get a little more complicated.
Thank you. Claudio?
Okay, so the first question about what's good about the international monetary and financial system. Well, obviously, a lot is good, because that system, together with trade liberalization, a liberalized trading system, has been the basis for the prosperity that we have seen for so long. That's why, at the end, I was emphasizing the fact that we don't want to lose it. You cannot really have trade liberalization without having sort of the finance sort of supporting it, and that's basically why we saw the evolution that we did. They're effectively two sides of the same coin. Now, having said that, my presentation was more about mitigating some of the weaknesses that exist there, so as to make sure that the system survives and continues. We continue living in that system. Negative rates, well, very simply, of course, if you have negative interest rates, other asset classes are going to be more attractive. Now, the question is which asset class, and that will depend on its characteristics. Gold has its pros and cons. On the cryptocurrencies, a little bit what Gita said, I think we have to make clear distinctions here. I mean, cryptocurrency is a very sort of broad term. You can go from what you might call permissionless blockchain systems. That's basically, Bitcoin is an example of that. They have problems of scalability, and they also have problems of volatility. That's why now we talk a lot about quote-unquote stable coins. Now, the question about stable coins, and we'll hear much more about that later, is that, well, on the one hand, if the idea of having a cryptocurrency was to do without, the current system, well, they're actually based on the system, because the underlying is the very foundation that gives trust to the currency. And then the key question there is going to be, as I'm sure will be discussed later, what is that is going to ensure that you are going to have trust in the cryptocurrency, in that cryptocurrency, and that you will be able to keep parity vis-a-vis the underlying, so that you're not going to have runs like you have in the mutual funds, which in turn means that it has to be profitable. And so the tension is going to be between maintaining the quote-unquote peg, if you like, and the underlying currency being profitable. And then you have other examples, other schemes that effectively just leverage the existing infrastructures and are based on blockchain technology, are based on tokenization, but they're a completely different kettle of fish. We're really talking about efficiency there, not much more.
Thank you. Hélène?
Yes, so what's good about the international monetary system? Well, all these interactions and this stable equilibrium with the dollar being used in many different functions obviously has a lot of efficiency benefits, and that's why it's such a stable equilibrium. So the question looking forward is indeed whether this is a stable equilibrium, given that the size of the US economy is shrinking. Now, on the cryptocurrency, so from what I put in the category of cryptocurrency here is everything which has to do with decentralized blockchain or decentralized ledger. That is to say, solving a kind of, for me, non-existent problem of trust when you perform a transaction by getting rid of any intermediary or any central counterparty and having everything through the decentralized ledger, which inevitably then requires a lot of validation since there's no central counterparty to actually do the transaction. You need to do extreme things, like in Bitcoin, you have a proof of work, so you're going to have to validate each single transaction, which in the case of Bitcoin then leads to completely unreasonable energy cost. And instead of having a more efficient medium of exchange, you end up with having a very costly medium of exchange, and also a medium of exchange which is extraordinarily volatile. I mean, just look at the value of any of these Bitcoin or Ethereum, etc. So that's not exactly a property of a good medium of exchange to be extremely volatile. So it's not a currency, it's like more of a commodity. And indeed, it's fairly hard to see fundamental value to that, therefore, unless you put some fundamental demand coming from the black economy or other such demand for these currencies. And the experience of Bitcoin and others has been indeed that there's a lot of fraud associated to that and a lot of manipulation of these currencies.
Okay, I'm just going to take one final quick round of questions before turning to the next panel. So now's your final chance to ask questions for the panel. Please, Rolf.
Thank you very much, Rolf Strauch, ESM. So I can confirm what Philip said about also the demand for ESM bonds as a safe asset. Part of it, the demand that we see, however, has also to do with politics, and what you said so far was relatively free of politics and the role also of the US policy. So my question to you is how robust the scenario that you are presenting of also the dominant role of the US dollar is to US policy, US and maybe more protectionism that we may be seeing in the future. Thank you.
Thank you. And here in the middle.
Thank you very much, Bernard Snoy from the Robert Triffin International Association. Well, in a conference dedicated to the future of the international monetary system, I wonder why so little has been said so far about the International Monetary Fund itself in its role to be more proactive towards a more efficient international monetary system, also as a global lender of last resort, and also about what should become the central asset in the international monetary system, the special drawing right. Professor Ray was the only one to mention it. Could we not devote more thinking to the role it could play precisely in this period of the declining hegemon? I think she raised very rightly the questions: who is fiscally responsible and who will be the lender of last resort, who will provide the liquidity? But I think that more attention should be given to those questions. Thank you.
Okay, thank you. And just at the back.
Paulo Guarda from the Luxembourg Central Bank. During the financial crisis, central banks lowered their interest rates and then they launched into quantitative easing. At the time, there were a lot of warnings that this would trigger currency wars. I'm not sure whether these wars took place. If you think so, what can we do about them? And if they didn't take place, why didn't they take place?
Okay, so let me close the questions at that, and maybe this time reverse Hélène.
Great. So on the SDRs, so I mentioned it in the context of saying indeed, you know, so it has not been used as an international currency because it is not backed by any it is backed by several potentially fiscal authorities, but it is not structured as a currency. So if we think about international liquidity provision in times of global stress, what is the liquidity that is needed on international financial markets? Well, it has been the dollar. Who has provided it? Well, it is the Federal Reserve. Now, there's an issue of who is taking the credit risk when there's international provision of liquidity, and this set of problems has not been solved for the case of the SDR, which will require some kind of cooperation among the currencies of the SDR baskets. So I think this international lender of last resort function being a key function of the currency at the heart of the international monetary system, we have to think about this type of issues, fiscal backing and who is giving the liquidity in crisis time. That's hard to think in the context of a basket. Similarly, if it were digital SDR, there would be similar issues there. And very briefly about the lower interest rate and the, well, what should we do? Well, we should do, the countries who can do fiscal expansion should do fiscal expansion.
Claudio?
Well, very briefly on the SDR, let me just make one point. Financial markets don't like baskets for many of the reasons that we heard before. If they want to decide on a particular portfolio, they can decide freely what that portfolio is going to be. A basket is constraining them too much. So expecting that something like an SDR would take off because of private demand, I think it's unrealistic. We saw that also, by the way, with the private EQ. Currency wars, the issue is not so much whether you're going to have currency wars as such, but as I was mentioning earlier, whether in a world in which you have very, very low inflation, easing in one country is going to be transmitted in other countries, but simply, for example, because you have inflation below target, exchange appreciation is not good for your mandate, and then you're going to have to do something. So these are not really currency wars, or the same if it has to do with financial stability and the like. It's more the fact of seeing this easing somehow being transmitted from core countries to the rest of the world, but simply as a result of individual countries following their own mandate. Now, you can think of, if you like, a bit of a prisoner's dilemma there, and that I think is the key question. But I wouldn't call it necessarily a currency war. I think that's probably not the right term. And let me stop there.
Gita?
Yeah, so on the question of protectionism and dollar dominance, I mean, it's clearly the case that protectionism doesn't help the world economy. The question is, would that at some point trigger shifts? And then the question that comes up is, to what? And given the issues we laid out about possible other currencies that could play a role, it doesn't look obvious at this point that would happen. And so the hope would be that actually we move back from growing protectionism and actually have a de-escalation of trade tensions. On the IMF SDR, I don't think I have anything more to add to what Hélène said and Claudio said. I agree that the IMF has an important role as the lender of last resort. It should be appropriately capitalized for that. And that will help also because it will, to some extent, prevent countries from building up their own reserves for a bad day. On currency wars, again, this is one of those things that I don't think anybody can point a finger at it and say that this is a currency war, because currencies move around for many reasons. When you use monetary policy by construction, you are going to end up affecting your exchange rate. Whether that then generates the benefits through expenditure switching on your trade balance, even that link is not that strong, especially in the short term. So, I mean, it's a term that gets used. I'm not sure everybody understands fully how that works, and I agree with what Hélène said, which is that there is a good case to be made that countries that have fiscal space should use fiscal policy.
Thank you. So maybe just in closing, I think one point that didn't really come up too much, I think it relates to the question of, the nature of the system is, of course, domestic monetary systems have developed quite a bit. So more and more countries around the world have a lot of their domestic transactions in domestic currency. And what's interesting in this current global slowdown is so many countries are now able to do monetary easing in response to their domestic slowdown, whereas historically maybe with more FX dollarization of systems and so on, we didn't have that. So now all of these issues we've talked about are very important, but we also have this parallel issue, which is there has been, I think, a big move forward in developing in the emerging world domestic financial systems, and I think we should keep that in mind. Having said that, I think there's a really excellent panel. Let me thank the panelists, and I'll hand over to the next panel. So thank you.
Okay, good evening. My name is Jean Tirole. I welcome you to this panel on cryptocurrencies, central bank, digital money, and Libra, or maybe the continuation of the panel, because the themes were tackled already earlier today. Just before starting, I would like to thank the Central Bank of Luxembourg and its governor, Gaston Reinesch, for co-organizing this conference, but also for the very fruitful relationship we have with Toulouse School of Economics, and this academic conference and this public event today are just another illustration of the fruitfulness of this collaboration. And finally, I would like to thank all of you for being here. I realize we are the last obstacle between you and dinner, but we have very exciting panelists on my left, or on your right, on my right for you. We are going to talk first and third, actually. So the first panelist will be Benoît Coeuré. You all know Benoît as member of the board of the ECB, but maybe more relevant to this panel is also chair of a G7 working group on global stablecoins, and also chair of a similar group at G20 on the regulatory framework. And then I'll be speaking, and then Maurice Obstfeld from the University of California, Berkeley, will be speaking last, and then we'll take questions for the floor. Again, as you all know, Maurice, for those of you who have studied economics, you have gone through his many pioneering contributions to international economics, and as well his big fat textbooks, and those who do policy, of course, know Maurice also as chief economic of the IMF, as was mentioned earlier. So without further ado, let me let Benoît start.
Thank you, Jean. Good evening, everyone, and let me also thank very warmly the BCL and TSE for putting together this conference, which has been great so far. So we'll try to keep the level. I guess we are taking the discussion where the previous panelists left it. So now we know everything about how the international monetary system works and how it evolves over time. And the question we want to dig deeper in is, is there anything new with cryptocurrencies and in particular with stablecoins, quote-unquote stablecoins, coming? And that's really the question I would like to try and answer. But maybe before I do that, I think it's useful to take a step back, and Gita and Hélène did it already. Over the past 50 years, the US dollar has defied all attempts of other currencies to throw it off its throne, to throw it off the Iron Throne. For those of you who followed the story around the Iron Throne, there have been many attempts to sit on it, and eventually, who eventually gets there can be quite surprising. So that could be the story of the international monetary system looking forward. But let me come back to the serious discussion. And so when you look at the recent history of the international monetary system, it looks a little bit like a Groundhog Day. In the 1980s, the story was about the yen displacing the dollar because Japan was then gaining international status, becoming an international creditor, and that didn't happen. And then in the 1990s and 2000s, the story was about the euro displacing the dollar, and it also didn't happen, as we've seen on the screens. And more recently, the story was about the renminbi displacing the dollar, and it still hasn't happened. So I think from an analytical standpoint, the really important question to move one step further is whether anything has changed. So is there anything different with cryptocurrencies and stablecoins? And that's clearly a very speculative discussion, because we're assuming here that all these projects will pass the regulatory test. And as was mentioned by Jean and by Governor Reinesch, there is an international discussion on how to address stablecoins. That started as a G7 working group, which started in Chantilly in July, and will deliver policy recommendations ahead of the annual meetings in Washington, D.C., so very shortly. And then there is also a Financial Stability Board group discussing the regulatory implications of stablecoins, and it starts as a regulatory discussion on issues we are not discussing today, such as compliance with anti-money laundering and counter-terrorism standards, investor protection, stability and safety as payment systems, etc., etc. And I think the mindset in the regulatory community is it's only when we are reassured that they can tick all boxes and pass the bar, and the bar is set pretty high, that we can have the kind of macro discussions that we are having tonight. So I'm just saying here that it remains a remote discussion, because we're really focusing on the regulatory aspects. And economists, I guess, would like to see it as some kind of a trade-off between safety and convenience. And there are clear convenience gains coming with stablecoins. It's cheaper, it's faster, it might be better for financial inclusion, etc. But we regulators don't see the trade-off. So we want it to be safe, full stop. And then we'll discuss the convenience. So just wanted to start with that. But now let us discuss the convenience and the impact on the international monetary system. And so what I would like to suggest here is that this time may be different. And so there may be features of cryptocurrencies, and in particular of stablecoins, that can make it different from what we've seen so far. That is a kind of very strong path dependency, very strong complementarities, which have been dissected by Gita and then by Hélène, which creates very strong path dependency and inertia in the international monetary system. That's what we've seen so far. And things could become different. That's what I would like to suggest, to throw and to start a discussion. And that's about the speed of transition, and that's also about the drivers for transition. And so these are two simple points, right? And there is a much more extended version on the ECB website if you're interested. So I just make the argument short, and you'll find the numbers and the details on the ECB website. So first, the speed. Starting point, as we said, is that so far we've seen a lot of inertia. But as was, I think, very aptly and importantly reminded to us by Gita, any international currency started as a means of payment, and it started as a wholesale means of payment. That is, it is being used by merchants. That's how the sterling started, right? As a currency being used by merchants. And that's how all international currencies have started. They start on the wholesale side. But we're seeing now the discussion moving to the retail side, that is to the customer. And it might be the case that international money adoption, currency adoption, looking forward, will be driven less by companies and merchants and more by consumers directly. And that's a different discussion. And that might change the way we look at it. If you look at the way consumer habits have changed recently over the last, say, decade, the number of internet users has doubled over the last 15 years, also the number of mobile phone users. Global remittances have increased by over 50% globally. Cross-border e-commerce activity has trebled. So you see consumer demand for global payment services, and that is new. And it's only natural that new payment solutions, such as stablecoins, are mainly targeting consumers and workers directly. They're not targeting merchants. And these solutions have been adopted much more quickly than in the past. If you take Kenya, for instance, which we all see as an example for us. I mean, I always say that the aim for developed economies is to catch up with Kenya when it comes to payments. The volume of mobile money transactions in Kenya has trebled in less than 7 years. And today accounts for half of the Kenyan GDP. So we're far away from that in our economies. And you see the same kind of development in China. So the point I'm making here is that with adoption moving from the wholesale side to the retail side, you could see also the speed of adoption changing. And so you could see the speed of transition from one equilibrium to another equilibrium in the international monetary system being much faster. So it remains a multiple equilibrium story, clearly, but the speed of transition could be faster. That's the first point. And the second point is that the drivers of the transition might also change. Some drivers of currency adoption will not change. Currencies have to be stable to be trusted. I guess that was a point made by, I guess, by Friedrich Hayek, long ago, when he advocated for international currency competition. He said, let's give a chance to the currencies that will prove the most stable, because that's the one that will be used. And there is truth to that. Currencies being well managed, currencies providing stability will remain an important driver, which is also why the discussion changes when it moves from cryptocurrencies to stablecoins, because there is this promise of stability. So whether this promise will be delivered on, I don't know. That's part of the discussion we're having with these projects. But clearly there is a promise of stability that can make it more likely that this would be widely adopted. If you compare, say, Libra and Bitcoin, I mean, there is a clear difference, if it works. But some factors could be new. We mentioned convenience, the cost being lower, the speed being higher in executing payments. But one important novelty here is the existence of underlying networks. And it might be easier to connect a new currency to an existing network, which is basically what the Libra project is about, than to build a network on an existing currency, which is the kind of process that we had in mind when we were discussing international currencies so far. And so you could see the kind of causality, the kind of sequencing that was described by Gita. You could see it being put on its head, because this is driven by consumers, and because it's not about building networks around a currency, it's about building a currency on an existing network. And that could make the dynamics quite different, also from a theoretical standpoint. And a second driver, but which is, in my view, more ambiguous, relates to privacy. I think there is a consensus, unanimity in the regulatory community that any stablecoin should conform to international anti-money laundering and KYC and anti-terrorism regulations. That's obvious, and that's, in a sense, the first box that we want to be ticked. And that would be the same for everyone. But stablecoins could differentiate according to how much personal data they collect and they process, and according to the way they use the personal data. And here we see huge differences in preferences globally. I mean, privacy regulations vastly differ globally. In Europe, we have GDPR, which provides a lot of protection to users. We don't see that in some other parts of the world. So that can be a different driver of currency adoption, which can also create fragmentation, because the underlying preferences and the underlying regulation will be different. So to conclude, and building on that kind of new dynamics, I can see three possible scenarios. The first scenario is about simply preserving the status quo. And that would be the case in particular if the conclusion of the regulatory discussion is that we are so worried about consumer protection, investor protection, etc., that we just don't let these projects lift off the ground, which is not what I wish, but it's a possible conclusion of that discussion. And then, of course, these currencies, by definition, will never will not challenge the international monetary system. That does not imply a digital standstill, and there is now broad understanding across the official community globally that with whatever happens to Libra and other projects, we have to use it as this was a useful wake-up call, and we have to use it as an opportunity to improve on our existing payment systems in particular. And Philippe mentioned TIPS, which for us in Europe would be really the basis for that discussion. The second scenario is central bank digital currencies. So Mark Carney in Jackson Hole floated the idea of having a synthetic hegemonic currency, SHC, the synthetic hegemonic currency, that would be provided through a network of central bank digital currencies. So here, of course, you have two sides, and you need to disentangle the two parts of that discussion. You have one discussion on having a global currency, and the previous panel had a little bit of a discussion on the SDR, so it's not a new discussion, I'm not going to come back to it. That has little to do with technology, and everything to do with the appetite for global cooperation on economic policies, which has been low since the end of Bretton Woods, and some would argue is even lower today. So the global aspect is one thing, but then you can have a network of central bank digital currencies. We are all working on it at different paces, and there is a case for central banks globally to join their forces and jointly investigate the feasibility of central bank digital currency, preferably based on shared technical standards. That with or without Libra, in a sense. And the third scenario is what Marcus Brunner-Meyer and Harold James and Jean-Pierre Landau have called digital currency areas. That is a more kind of jaded, more complex landscape, where policymakers would successfully coordinate, possibly across a number of jurisdictions, to conclude that stablecoins can happen because the regulatory prerequisites will be met. But that doesn't have to be global, it can be regional. And in a sense, since it requires a prior degree of legal coordination and even political coordination to agree on conditions being met, I would probably suggest that any digital currency area will also be a regional currency area. And Europe, of course, might be the place where this happens because we have a common regulatory approach by construction. So that would entail some fragmentation of the international monetary system, but it's already fragmented after all. And the transition towards it would still pose challenges to public policy. Currency substitution has been mentioned by Gita, and it's an important concern when it comes to the transition to stablecoins, global or regional. Stablecoinization, sorry for that awful word, stablecoinization in an economy would likely start in economies with high inflation and weak institutions, low credibility in monetary policy, and can be a clear challenge to monetary policy autonomy. And global stablecoins could also increase capital flow volatility. They could have an effect on exchange rate and financial conditions, and then on inflation outcomes. Which we certainly have to understand better. And at a higher level, what I've called stablecoinization, that is substitution from the local currency into stablecoins, would potentially relegate key policies that belong to the public sphere to private payment providers, to private institutions, well, big tech in particular, which is an outcome which citizens clearly cannot accept. So I end with that, and the conclusion, I guess, in one sentence, the one-sentence conclusion for us central bankers is that you can conceive a future where we would have to work harder on central bank digital currencies. You can conceive a future where we would have to work harder on improving, upgrading payment systems to answer the question that stablecoins have been asking in the first place, that is convenience of payment systems. And you can conceive a future where we would have to work harder on the regulatory environment that makes it possible in a safe way, and I guess it's going to be a little bit of the three.
Well, thank you, Benoît. I have some slides, so just waiting for the slides. Yes, thank you. So let me start with the big picture. It's pretty easy to get lost, including myself. I often get lost in the detail because you have so many different possibilities. We now have many cryptocurrencies. We have stablecoins. Stablecoins vary depending on the backing. Is that in fiat currency, or is that through over collateralization in the underlying cryptocurrency, which requires, of course, a lot of trust, and that raises the issue of who is going to actually prudentially supervise those insurers, because they're de facto insurers. And to that respect, they have to be supervised by an authority. There is private money, Libra, Facebook, but of course, all the other platforms are going to have the temptation, like Amazon and others, to introduce private money. We could have digital local currencies, central bank digital currencies. Even that is not well defined because many variants are being discussed. What's sure is that there is a demand side and a supply side. We are economists, right? So the demand side is, of course, low-cost transactions, low fees, low collateral for financial markets, financial inclusion, especially for cross-border payments. Of course, it's very useful to have those alternative modes of transaction if you are in Venezuela or another dysfunctional monetary system. But of course, there is another type of demand we like less: money laundering, crime, tax evasion. I will put controversially libertarian ethos there. And on the supply side, of course, there's of course the public side, but the private sponsors, they look for a profit. One of them may be a seniorage. They may also collect transaction fees if there are transactions. And side benefits, maybe consumer lock-in, thanks to the currency, maybe data collection. Of course, for Facebook, it's very important. Ancillary services of how to deal with that. There are business challenges and there are public policy challenges, and I just want to list them and leave it to Maurice to answer and Benoît to answer all those challenges. But let me list those challenges. There are issues which have to do with governance. So there are lots of decisions to be taken. I mean, even in Bitcoin, you have to decide what to do when you have a forking event. What happens if you have scalability issues and you want to expand the system, and you need a decision rule, just like for any organization. It could be 51%. 51%, of course, give rise to coalition and manipulability. It could be supermajorities, unanimity, but then there is a threat of deadlock. That's an issue. If you have a centralized system, it may be run by a dominant player, but then, just like any organization, you have to make sure that the other stakeholders are protected against abuse by this dominant player. Or you can have some kind of cooperative. Actually, you all know that Visa and MasterCard for a very long time were actually cooperative of banks, of issuer and acquirers. Now, Libra is some kind of cooperative, interesting one, because we know that cooperative from the work of Henry Hensman at Yale actually work very well when everybody has the same objective. But when you think about Visa and MasterCard and you compare that to Uber and Spotify, leave alone Facebook, the goals are very different. So I'm just very curious about how it's going to work. Then the second challenge beside governance is transaction friendliness. So basically moving from a store of value, a speculative store of value, to some means of payment. And you have to solve two things. One has already been mentioned, which is that all those things are pure bubbles, and therefore they are likely to be highly volatile. But also there are two-sided markets. So if you want to those cryptocurrencies or others to be used for transaction purposes, you must attract sellers and buyers. And at this stage, most of those instruments cannot compete with Visa, MasterCard, PayPal, and all those things, which have been building on a business model for now decades, which is basically the business model which is predicted by the theory of multi-sided markets. And you have to comply with that unless you will have some kind of other platform which is going to sit on top of the system and basically do what the currency is supposed to do. Public policy challenges. I see 7. Probably we'll have add some later on. And the first is how to deal, and that was mentioned several times, including by Benoît, how to deal with money laundering and tax evasion and crime, blah, 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 so it's well known. There is a possibility of market power. I remind you that the EU is investigating into Libra now. There is a possibility of bundling and tying, which might increase market power of Facebook or Amazon when Amazon does it or whatever. You have the loss of seniorage. For me, seniorage, at least I grew up in a world where seniorage was going to the public sector, and I think that's the right thing to do. And when you see what's happening now with seniorage, Hélène mentioned that it's often wasted. You know, it's a zero-sum game. When you mine bitcoins, you spend electricity and specialized computer equipment with no social gain, actually a social loss. Sometimes seniorage is prioritized through initial coin offerings. So it's not that nice because I think that belongs to the treasury in some way. Then there are issues with privacy. It's true for Libra, of course, but it's also true if you have a public platform. Of course, many are worried about the government having, at least in some countries, in other countries, the government already has the data, but having data about everything you purchase and so on. Then there is a bunch of issues about investor or depositor protection. So at the very least, you want to inform people about the risks they face in terms of swindles, hacking, fraud running, whatever, that kind of things. So I think, you know, we are in a new world. And in a new world, you have the risk of small people being ripped off, and of course, you need consumer protection. But it also becomes a public issue having to do with public money. If the government is held responsible for the failure of small depositors or SMEs to, when they lose money to those systems, and then maybe the public money may be involved. Keeping on with investor and depositor protection, there's the issue of prudential supervision. Whenever there's a guarantee or a backing, that's an insurance system. There must be a prudential regulator. Who is going to be this prudential regulator? Who is basically going to create trust in the system? You have a standard issue. For banks, it's you know, the LCR, or capital adequacy requirement. For insurance company, you have similar issues, especially on the capital side. And there will be a very strong temptation for Libra and others to, after a while, of course, you're not going to do that immediately, to basically start under holding safe asset, and there may be a lot of money which will be at stake then. And there's a challenge for financial stability. How do you deal with capital control? How do you operate capital control in such a world? What about those currencies being used for as run to basically have a run on the domestic currency? I mean, that can already happen, but maybe it's going to facilitate that. And how do you run, so you are in 2008, and how do you run counter-cyclical monetary policy in such a world? So 7 very simple challenges to solve for you. And my view is a pushback from authorities entirely vindicated. Benoît actually said also we should pay attention to what's going on because we are lagging behind. Public sector is lagging behind. There is innovation from the private sector. Some of it is very useful. It's a new technology, that's great. But basically we are lagging behind a little bit, and the danger is that those things will develop very fast. And the last point I want to make, I won't have time to discuss things further, is that we have a new technology, and that's wonderful. It's cheaper and so on. But the economic fundamentals are still there. It's not because you have a new technology that you are going to get rid of two-sided market theory, that you are going to get rid of the fundamentals of credit and delegated monitoring, and that you are going to get rid of the issue of solvency and liquidity of intermediaries. Let's never forget that. Thank you.
Okay, I'm just waiting for my slides to appear. Thank you. I'm going to focus more narrowly on the case of Libra, because as it turns out, tomorrow is the 3-month anniversary of the announcement by Facebook and the release of the accompanying white papers. And I think it's fair to say that 3 months later, we don't know a lot more about Libra than is in those white papers. Libra is often described as a stable cryptocurrency, and this puts me in mind of what Voltaire said in the 18th century. He said that that which is called the Holy Roman Empire is neither holy nor Roman nor an empire. And I think one could say of Libra that it is neither stable nor crypto nor a currency. It illustrates quite well a lot of the problems that have been brought up more generally by Jean and Benoît and by the earlier panel. But given the ambition of the project, I feel that the threats are greater. And as you'll see, I'm going to be fairly negative. I'm sure Hélène is going to agree with me on this. I'm going to stand so I can actually see my slides. Okay. So when Libra was launched to the world 3 months ago, Facebook made a number of promises, and it promised a simple global currency and financial infrastructure that empowers billions of people. Whenever I hear the word empowers, I get very suspicious. We hear it a lot in California. Designed and governed as a public good. Public good makes me nervous also. Its value will remain relatively stable over time, fully backed by a reserve of real assets. It's basically a floating net asset value mutual fund. The freedom to easily transmit funds across borders. This is a great benefit, as Benoît indicated, particularly in view of the need for low-cost remittances and the slow speeds currently of cross-border payments. And finally, a new opportunity for responsible financial services innovation. As far as one can make out from the white papers of Facebook, the Libra architecture, I call it ostensible because I don't really know, but this is what I sort of got out of reading the white paper. Now, the sort of orange, the sort of Financial Times colored circle is the Libra distributed ledger network. And that's the environment within which the end users transact. There are validators, ultimately hoped to number 100 or so, who validate the transactions. So this is Visa, MasterCard, Uber, whoever. But this is kind of a closed system. How do you get out of this system into fiat currencies? Well, the Libra holders interact with exchanges, who interact with authorized sellers, who are the only ones allowed to trade in or out of the purple Libra reserve. The Libra reserve holds the assets that back Libra, and trades with the markets are carried out by custodians. So the point I want to make is that at each sort of point, there is the possibility of frictions and transaction costs in getting from Libra into what one might call the real world. So what's the reality versus the promises? Within currency areas, fast payment solutions are evolving relatively quickly. Within the European sphere, as Philip mentioned, the revised Payment Services Directive, TIPS, have changed the landscape. India's unified payment interface. There could be real, or what Tobias Adrian has called synthetic central bank digital currencies. In the latter, e-payment providers would actually be the holders of central bank reserves and might carry out some of the surveillance to counteract anti-money laundering issues or financing of terrorism. There are some cross-border payment options that are still on a small scale, like PayPal, Zoom. And there's definitely a need for central banks to step up in this sphere and somehow ease the process of international payments. This is a big task. It requires coordination, interoperability, regulation, And frankly, we are in an environment these days, a policy environment, a conflictual international environment in which this doesn't seem like it is most likely to happen. But I would say that that sort of environment is also a environment in which one would be even more worried about introducing something operated by a private operator such as Facebook. But as I indicated, I'm not sure that going through Libra is going to reduce costs all that much, given the many, many steps and the many, many questions of how you transfer into domestic currencies. So what I would conclude is that for larger countries, areas for which, taken as a whole, external trade is not that big, domestic money and payments are going to continue dominant. And this is going to be reinforced by the fact that Libra is not promised to be stable in terms of any fiat currency. The value of the reserve is going to fluctuate. I think one exception to this is the idea that it could be that if negative interest rates persist and get deeper, they may be more of an incentive in advanced currency areas to move to something like Libra. While Libra is advertised as safe, I also can envision money market mutual funds, perhaps supported by the Facebook interface, springing up, offering to invest end users' idle Libra balances for profit. And how those would be regulated, what the consumer protection issues would be, are big question marks. There are further risks, and I view some of these risks as applying particularly to smaller countries, the smaller, poorer, open economies that risk Libraization. And here I'm adopting Benoît's terminology with a particular example. Now, this I view as a form of colonization, pure and simple. Facebook has large user bases in these countries. In fact, Facebook in a number of these countries has played quite a destabilizing role through the propagation of hate speech and generally violence encouraging messaging. Facebook would like to monetize its big user base in these countries, which don't yield much revenue because there's not much advertising revenue to be had. So Libra becoming big in these countries could be a source of seigniorage. It could be a way of monetizing apps that interact with Libra in other ways. And this is a way of really extracting resources out of these countries. It's possible that Libra could discipline policies, but the policy discipline argument is one that rarely works. More often it leads to self-fulfilling crises, multiple equilibria type runs. I think there are other risks to the global system. Imagine that the Libra reserve actually becomes quite big. The promise to hold it in safe assets risks pushing safe rates of return down further, exacerbating the global safe asset shortage. Per Deutsche Bank now, roughly 27% of global bonds have negative interest rates already. So for Libra to actually be safe, it would largely have to hold dollars. But I think it would ultimately be tempted into riskier assets. I mean, the model that has been advertised is one in which holders do not get interest. So at some level, moving into riskier assets would create a situation where end users are taking all the risks. Heads, the Libra reserve wins. Tails, the end users lose. Facebook promises that the reserve balance sheet will be auditable and transparent, but I do wonder about the process of portfolio rebalancing, the potential to destabilize markets if it is very big. Imagine if information gets out or rumors get out about potential shifts in the currency denomination of the Libra reserve. There could be self-fulfilling events or a possibility of front-running. So I don't think that the sort of narrow banking model that has been proposed is likely to hold true. Okay, now Jean mentioned supply and demand. So we have to come back to supply and demand. And I want to suggest how the sort of equilibrium supply of Libra might be determined in such a world. In this chart, the quantity of Libra is determined by the intersection of demand and supply curves that depend on the risk of the Libra reserve. Obviously, as the Libra reserve is perceived to be more risky, the demand for Libra will fall. That's the downward sloping schedule. A bigger reserve requires the reserve portfolio to take more risk. There are just so many safe assets out there, and I would argue that the incentives for a larger reserve would push the management into more risk. So here you see an equilibrium where the two curves cross. Now, the interesting thing about this equilibrium is that it leads to a level of Libra that is inefficiently large. Basically, every consumer who buys Libra will push the Libra fund into riskier assets, but they will not internalize that effect. So we have an externality here, which ideally regulators would want to deal with if Libra came into being. Now, of course, this adds to the case for regulation, which is already strong for all of the reasons that Benoît and Jean talked about. Any sort of regulation will require very strong cross-border coordination, and that too is a challenge. So I'll stop there.
Thank you very much, Maurice. We are going to take a couple of questions in a row. Please identify yourself and raise your hand because, as Phil said, we don't see very much here. I see some people raising their hand there, one there.
Thank you. Philip Thomas, I'm Fiji's honorary consul here. Could what is currently happening be viewed as a campaign by the entrenched central banks to malign potential competition? Because what is at stake is the soft power of the issuing states and also seigniorage. On the other hand, couldn't also Libra or those behind it become a sovereign actor themselves, for instance, by acquiring Greenland, which seems to be in the market? Could not China create a second currency where there would not be any restrictions? Because that seems to be what is holding back China in launching the renminbi as a national currency. And could not Facebook and others enlist a sovereign state, say Singapore, which has a reasonably good reputation, speaks English, etc., and that state could, in a way, front for a new currency, which would deflate the current argument that no non-sovereign actor should issue a currency. So this would get around that and into the safety of a situation where the regulator of the currency and the issuer are the same, just like in Venezuela. Thank you.
Gary Robinson from the Luxembourg Institute of Socioeconomic Research. A couple of points. So the first one was to take up the point about central banks getting involved in cross-border payments. And I think there's been a few projects already, like between the ECB and the Bank of Japan, and I think the MAS in Singapore and Bank of Canada as well, and perhaps also Australia and China. So your comments on whether you think central banks actually do want to get into this and perhaps provide alternatives to correspondent banking. And the other point was about the potential for programmable CBDC as a policy tool. For example, conditional helicopter money, where you could do transfers to citizens and perhaps they could only be spent within a certain time frame and on certain things and not on other things. Thank you.
Hello, here. This is Teuta Turani from the ESM. My question was more on the central bank digital currencies. So I feel like all of these alternatives have been a bit of a response following the failure of the official sector to provide low-cost and frictionless cross-border payments. And I feel like the central bank, in a way, has stepped in and tried to provide other alternatives through the digital currency. And a lot of supporters would argue that this is great because, in a way, the central bank, through these digital currencies, can impose negative interest rates more broadly, or it can provide unlimited safe assets and so on. My concerns are more about, are central banks ready to do that? And I focus mainly on two main points, which is, first of all, entering the retail business. Are central banks the most cheap and efficient alternative to enter this business of retail? Even when thinking about very basic things like dealing with customer complaints or user questions, or just providing some know your customer analysis and so on. So are central banks ready for that? And the second point is about privacy. If these transactions are guaranteed to be private, then the central banks could facilitate money laundering, which is a big issue. So is that another thing that central banks should be thinking of? Thank you.
So there are many questions directed to central banks, but before answering, and I will answer, I would just like to make a simple point, which is that the definition of money and the use of money is not to be decided by central bankers. It's decided by parliaments in all countries, and that's prepared by finance ministers, which is why G7 finance ministers and now G20 finance ministers are very keen on having that discussion. So this is not an attempt by the global central bankers coalition to protect their market power. That's a much deeper discussion which has to be adjudicated by parliaments. It is a political discussion. And it is about the ability of any payment system and currency scheme to deliver what citizens expect, which is basically price stability on the one hand, and also the safeness and robustness of payment systems. So that's what the discussion is about. And now, first, I don't think there is any different approach internationally to these questions, to these high-level questions. So China was mentioned, Singapore was mentioned. I mean, they are part of the discussion. They are sitting on the, not on the G7 group by definition, but on the FSB group. Certainly, these are discussions we're having in Basel at the Banque for International Settlements, and I don't see any different approach from Singapore and China. And they are very active participants in that discussion. So the notion that there could be some kind of race to the bottom in terms of safety or in terms of sovereignty, that's not. It's possible. It's always possible, but that's not something we're seeing at all. There's really a wish and a very strong resolve to have international coordination and to come to an internationally consistent answer to all these questions. So that's the first thing. And second, now the solution will be a mix of public and private elements. So it's not a discussion between do we want central banks to do everything or do we want the private sector to do everything. I mean, existing payment systems are an architecture where part of the architecture, typically the core backbone is provided by central banks, but not even everywhere. And the front end is provided by the private sector. And many applications are being provided by the private sector. And so there is no reason why it should be different. So it's only a different way to address that discussion on what's the best way to interact and to put together public solutions and private solutions. The fact is that, until very recently, Private innovation in payments has been really focused on the front end. I mean, think of PayPal as an example. So that has been about providing a good interface to customers, but without changing the backbone. And it's only recently with stablecoin projects that we're seeing projects which really also aim at providing different solutions to the backbone. And so that's an entirely new discussion. We'll have to make sense of it, but I'm very much convinced that the end game will be a mix of public and private solutions. And now all the questions on, are you going to use that to have more negative rates? Are you going to use that to do helicopter money? I mean, that's a totally different discussion. So, and by the way, we're not doing helicopter money, and there is no plan to do that. And we do have negative rates, but that's a monetary policy discussion. So we're not going to mix up the two discussions, and we're not going to choose a particular path for monetary policy reasons. So let's keep the two discussions separate.
Oh. Sorry. What do you need? I don't have much to add to what Benoît said. I'm not myself a central banker, but I don't feel that the concerns that central bankers have raised are because they're worried about being put out of business or losing seniorage. I think they're genuine consumer protection and financial stability concerns that have to be dealt with. I think the suggestion that China, for example, could issue a currency, a digital currency for the whole world to use was interesting, although it would have to be one that was an offshore currency, which they did not allow Chinese residents to use unless they're willing to dismantle their system of controls. And I think that would raise a lot of incentive issues about how it is managed and the backing. So I think it would be a difficult sell. The idea of conditional central bank money I found very interesting. One of the textbooks that Jean mentioned is an undergraduate book, and the textbook business is actually changing because of the efficiency of the used market for physical books. And what many publishers are doing now are moving to a model where students will not receive books, but during the period of a course they will receive, basically a password to the book, which is non-transferable and which will then expire at the end of the course. It's very much like this sort of idea. And whatever you think about this morally, I'm not sure what I think about it. It's one way of maximizing profits. The problem with conditional central bank money is that you sort of remove the store of value function. So I'm not sure what happens to it after you spend it and it goes to someone else. I'm sure there'd be ways to sort of renew the license, but I don't think governments are ready to go that route yet.
Okay, so I suggest it's getting late, but it's fascinating. So a last round of questions. Please keep the question pretty short.
Hi, this is Jason Ray. Just a quick question. The conference, Future of International Monetary System. The word future, I think it's been very interesting in every way so far, except there's a bit of an elephant in the room, and that is the whole threat of climate change to the world, and the fact that the IMS has perhaps been instrumental in getting the world to where it is today, enabling global trade and globalization, with the consequences to the global climate as a result. And my question is whether the international monetary system can be used for good in some way to kind of ensure that trade is made in a way that will help reduce the impact of global trade today, which is damaging the planet more. So perhaps we talked briefly, I think, about money that can only be used for certain purposes. And I realize this is a political question and the central banks are not politicians, but somehow a mechanism which helps steer the wealth of the world in the right way rather than just encouraging the status quo.
My name is Rana Malla. I'm from the London School of Economics. My question is about Libra in particular. If, let's say in small, unstable economies, Libra becomes seen as more stable and safer by the people there than their local currencies, and if a scenario is possible of increasing illiquidity of local currency as Libra becomes increasingly adopted, leading to an equilibrium of abandonment of the local currency and consequently of abandonment of their independent monetary policy. Could that be a concern of the ECB or the Federal Reserve, for example, and should there be a concern for regulating for these challenges?
Okay, so, well, let me take the first question on climate change, because that's a topic which is dear to me. The prime is not trade per se, it's much more general. It's our unwillingness to act. We free ride on other countries and we just don't care about future generation, and that's a point. And I think economists almost all agree that there's a solution. Have a decent carbon price, which you don't have, except in Switzerland, in Sweden, and a little bit in France, but we've seen what happened in France. It's our unwillingness to act, and almost all economists agree with that. And look for crazy solutions, which are totally undoable, because we become politicians and we want to say it's not going to cost anything to fight climate change. I think it's a scandal. If you want to see my view on that, read chapter 8 or 9 of Economics for the Common Good. If you speak French, read Christian Gollier's recent book, which is very good. And now what is the role of the financial system in all that? There is a small one. Because what we need is actually to give an incentive for people actually to economize on carbon. As long as we don't have that, and it's a very important price signal, by the way. If you ask me, should I consume vegetable from Toulouse or consume vegetable from Spain? You might say from Toulouse it might be more appropriate, but then if we need greenhouses in Toulouse with electricity and so on, it's not clear. How can I do the computations? It's a matter with international trade. If you have a price which corresponds to the externality on the rest of the world, it's a different ballgame, because I don't need this information anymore. It's embodied into the price of my goods. So that's what we need. Almost all economists agree with that, with some variance. Of course, the details are much more complicated than that. If you go for a cap-and-trade solution, so you look at the carbon budget, the carbon which still has to be emitted to stay under 1.5 degrees Celsius, and you issue the corresponding number of permits, then you have to make sure that the countries abide by their promise, and they need to buy the permits if they have over emitted carbon. And that's where it should become a national debt, in my view, and that's where the IMF might step in, because the carbon commitment by countries is like a debt commitment. It's another form of debt. And the market price basically tells you how much you owe to the rest of the world. And that might be a role for the IMF. I'll stop there. There's a question about Libra, but I'm not going to monopolize the speech.
Well, I think for poor, smaller countries, there is the risk that they become Libraized, basically, that people flee the domestic currency and use Libra. And in that case, there would be less of a cost of remittances to those countries in terms of Libra, because you wouldn't have to go into their domestic currencies at the other end, but those countries would give up monetary sovereignty. Now, that's not always a bad thing. I think if Venezuela currently gave up monetary sovereignty, that might be a good thing. But in most cases, it's not. I don't think that's a concern really for the Fed or the ECB, but it would be a concern for citizens of that country.
Oh, and I mean, I fully agree with Maurice, and it makes a point that the costs and benefits of stablecoins are different across countries, and they are clearly different, and of not only of a different nature, but also of a different magnitude in developed and in emerging, and even more in low-income economies. And I would argue that in many low-income economies, both the costs and the benefits are higher. So the terms of the discussion are, the stake of the discussion is higher, because the potential gains in terms of, in particular in terms of remittances, in terms of cross-border payments, are higher. And that's the main business case of many of these projects, right? That's the main economic case. I mean, I don't think anyone expects, and even Facebook doesn't probably expect Libra to be used to buy a beer out there in Luxembourg. I mean, that's not the business case. The business case is really primarily about cross-border transactions. That's where it starts. And so that makes the stakes higher for smaller, more open and more vulnerable economies. And it is a concern also for the ECB insofar as it is a concern for the system as a whole.
Just to come back to the climate thing, if the sort of Bitcoin blockchain were scaled up, the amount of energy and the resulting carbon emissions from that would be incredible. So putting a price on carbon would probably put Bitcoin out of business.
Good. Okay. So I suggest with this wisdom of Benoît and Maurice, we stop here. I just want to thank all of you for staying that long. But that was fascinating. I want to thank all the panelists of the two panels, and of course Gita, the first speaker, for being here, and very interesting. So thank you very much and have a good evening.